U.S. The first quarter comes to a close this week, and Standard & Poor's is expecting to see some improvement in corporate earnings compared to 2009. Howard Silverblatt is senior index analyst at S&P. He joins us now from his firm in New York with his assessment of the first quarter. Howard, welcome back to Bloomberg. Always good to see you. Happy Passover.
Thank you.
Howard, we were talking about the numbers that came out today. Consumer spending rising in February, fifth consecutive month. Personal income essentially unchanged. What are you to make of these numbers?
Well, the numbers show that consumers are spending. We're seeing corporations and we're seeing individuals spending. We had several companies this quarter. 8 companies actually have initiated a dividend, which is very strong, and many of them were consumer discretionary. Carnival, Marriott, and Starbucks. This all goes to consumer spending, discretionary spending. So we're seeing it seep through. We're also seeing CapEx starting to increase. So the money is starting to go and the sales are starting, but it's just turning around now, and we're starting to feel some of it.
At least a sense that this might be sustainable at this point?
Well, that's going to depend on the job market and the economy itself. If people get shaken by the numbers, especially the unemployment, they're going to start pulling back. Companies are not about to commit capital expenditure money going out for a year or two if they're worried about what consumers are going to spend. So we are very much in a job market situation. But the numbers definitely have gotten better, especially balance sheet income numbers.
I'm glad you brought that up. Do those balance sheet numbers give you pause going forward in the second quarter?
The second quarter is going to be about 70% higher than year over year because 2009 was such a poor year. The year itself, we're looking for about a 37% gain, but that just brings us back to 2005, 2% over that. So that's about where we would be if we got what we're expecting. And the market back there was 1248. So again, the numbers have turned around, but it's going to be very slow. The big item we're looking for now is sales. They have to increase if you're going to get them to increase the bottom number.
Howard, talk to us about this S&P number that we've seen in the first quarter.
Which number?
S&P 500, the index?
Oh, the index itself?
Yeah.
A very good March. We're up almost 6%. January, February was down. It definitely did not do a lot in volume. Hopefully Citi will add to that. But the movement was up. So if there was profit taking in there, it has worked its way through. So we've got a nice, strong gain at this point. We have 440 issues up this month, which is very positive. And consumer staples is actually now positive on a total return basis from the 2007 highs, which is a statement in itself.
Howard, you mentioned the Citi story, and I asked our guest earlier, how big a deal is this?
It's a large item, obviously, to Morgan Stanley as well as to Citi on an index basis, obviously. If these shares come in, it's going to cost about $3.8 billion in index buying, over the time period, because companies are going to have to match that. So it is a major deal, and we do expect to see a lot of positive items on financials, not necessarily Citi, when it comes to dividends this year.
Is this going to give institutional investors an impetus to jump back in now?
They may take a look at that. Citi is a special case, again, going all the way down, then coming back to where we are now. There's going to be a lot of volume in there and a lot of ways to play that. So I would say that's more of a professional's market than an individual, because you've got to really know how you're getting into it and what you're setting up for options and hedges.
Howard, before I let you go, can we talk overseas for just a second and the situation that dominated the quarter, the situation in Greece? How did that affect things here in the U.S.? Can you give our viewers a sense of how Greece's finances may have roiled the markets here somewhat?
Sure, and I'm talking from an equity side point.
Sure,
I'm not within the bonds. The concern was on the euro, obviously. We've seen a steady deterioration in it, the stronger dollar. There's concern whether or not they will support all the countries as part where the IMF is going to go in. The new 7-year note that Greece is supposedly putting out now does help the situation, but it definitely unraveled a lot of the U.S. markets because concerned that a municipality, a sovereign entity like this, could have such difficulties. And there's a lot behind them. I mean, within the U.S., we see difficulties on many states, and it's not a foreign situation, really. it really is a domestic as well.
And Howard, in our last 20 seconds, because of that situation in Greece, you were talking about the dollar. We see a lot of people headed towards dollars now?
We do, more away from the euro. So it's not that they favor the dollar so much. When it comes down, perhaps it goes back the other way. We are expecting still a lot more growth, especially in the emerging markets. We also have some indices here, and we're expecting a lot of growth there. But short term.
Is that part of that refrain anything but the euro?
Well,
yeah, that's what I thought. Sometimes I didn't mean to put you on the spot, but yeah, we hear that from a lot of folks. Howard Silverblatt, Senior Index Analyst at Standard & Poor's, joining us. Howard, it's always a pleasure to talk to you. Thank you so much.